Welcome back to the Walnut. Let's take a look at what exactly the difference between simple interest and compound interest. I'm pretty sure you heard of these two words, simple interest and compound interest. First of all, what is interest? Well, if you invest your money in a bank, at the end of the year, you get a certain amount of money extra. That is called the interest. Or if you take a loan from the bank, let's say you take a loan of 50,000 rupees. You have to pay something extra along with that 50,000 when you pay the loan back. That is called the interest. Right, so this case, let's take a look at the illustration here. You will get a clear idea what is the difference between simple interest and compound interest. So let's say the simple interest, you have invested 1,000 rupees in your bank. So beginning of the year one, you have 1,000 rupees. So you invested 1,000 rupees and naturally, you know what, you are supposed to get an interest. So let's say you get 10% interest. So your interest for the first year is 100 rupees. So 10% of 1,000 is 100. So you have interest of 100 rupees. At the end of the year, what you have in your account? You have that 1,000 rupees plus you have an interest of 100 rupees. So 1,100 or 1,100 rupees in your account. And what happens the second year? You did not withdraw the money 1,100 rupees in your account, no change. Well, what happens next year? Year 2. So the bank consider your investment as 1,000 rupees. Even though your account has 1,100 rupees, they consider your investment as 1,000 rupees. The beginning of the second year, you have 1,000 rupees as investment and you get an interest of 100 rupees, that is 10%. So at the end of the second year, already you have 1,100 rupees in your account plus you have this 100 rupees interest. So altogether what you have is 1,200 rupees in your account. What happens in the third year? The beginning of the third year, the bank considers your investment, your principal amount as 1,000 rupees. And of course your interest for that 1,000 rupees would be 100. 10% of 1,000 is 100. And at the end of the third year, what you have is, already you have 1,200 rupees in your account, plus this year you have an interest of 100 rupees. Altogether what you have 1,300 rupees in your account by the end of the third year. So that is simple interest. Alright, so what happens in compound interest calculation? So compound interest, so the beginning you have, let's say you have 1,000 rupees. And year 1, beginning you have 1,000 rupees and interest 10%, same interest. So you'll have 100 rupees and at the end you have 1,000 plus 100, that is 1,100 rupees. That is exactly same as the simple interest. Now the difference that comes the beginning of the second year. So the beginning of the second year, what happens? The bank will consider your investment as 1,100 rupees, not 1,000 rupees, 1,100 rupees. What is left out in your account as the balance, that 1,100 rupees will be considered as the principal amount here. So if that is the principal amount, then we'll get 10% interest on that principal amount, 1,100 rupees. So what is the 10% of 1,100? 110. And at the end of the second year, already you have 1,100 rupees in your account, plus you have 110. So what do you get? 1,210 in your account. Now, the third year, what happens? The beginning of the third year, the bank will consider the whole amount of money in your account, that is 1,210 as your principal amount. And they'll give you interest for that 1,210. So how much is that? 121 rupees. 10% of 1,210 is 121 rupees. At the end of third year, you'll have 1,210 plus you have the interest 121. So ultimately what you get? 1,331. So at the end of the third year, in your account you'll have 1,331 rupees, and in this case it is 1,300 rupees. The difference is what? 31 rupees for 1,000. If it is 10,000 rupees, what would be the difference? 310 rupees, right? If it is 1 lakh rupees, see that difference? 3,100 rupees. If it is 10 lakh rupees, see the difference? So that is how the compounding makes a huge difference, especially if you take a loan. Definitely the bank go for compounding interest. And if you invest your money, normally the bank go for simple interest method. So that's a major difference. If you invest your money in the bank, they go for simple interest calculation, so they need to pay you less interest compared to compound interest. And if you take a loan, they never go for simple interest, they go for compound. And especially if you take a housing loan for 30 lakhs and your payment period is 25 years, see that? It's a long period and a huge amount of money. Even, 1% difference, and even that calculation simple interest and compound interest, that takes a huge difference. That makes a huge difference at the end of this 25 years when you pay back 30 lakhs rupees with the interest. So that's a major difference between simple interest and compound interest. And this is something really important for your personal life and the professional life as well, especially when you deal with the banks and financial institutions, when you think about investment and when you take a loan. All right, so let's take another example. A person invested 80,000 rupees. 80,000. Well, this is 80,000. If it is simple interest and if it is compound interest, how much difference that make? If it is simple interest, well, if it is 10% per annum. So if it is simple interest, 10% per annum, how much is that? Simple interest. 10% per annum, it is 8,000 rupees. And they invest for 2 years. So 8,000 into 2 years, correct? How much is that? 16,000 rupees. So simple interest. If it is compound interest, what would be the interest? 80,000 for the first year, year 1. Compound interest. The first year, how much is that? 10%, right? So 10%, that's 8,000. And for the second year interest, year 2. Second year interest, well, it would be 8,000 plus. You will get an interest for this 8,000 rupees you earned in the first year. So you'll get the interest on interest. So 8,000 rupees, what is the interest? 10% interest on 8,000 rupees is what? 800. So second year, your interest is going to be 8,000 plus 800. So altogether, if it is compound interest calculation, so total interest for the year 1 and year 2 together, it is 16,800 rupees. The first case, simple interest, it is 16,000, and for compounding, it is 16,800 rupees. Right? So what is the difference? It is 800 rupees in 2 years. If you take a loan of 8 lakh rupees, how much does that make in 2 years? Think about it. If it is simple interest and compounding interest, it makes a difference, right? If it is a loan of 80 lakhs, so let's say you take a business loan for 80 lakhs, huge amount, right? The difference will be huge amount. All right, so what is a simple way to calculate the interest in case of simple interest? So we have a formula for that. What kind of a formula? The formula is simple. We call it PNR. What is this PNR? P means principal amount. So this case, the principal amount is 80,000. N, the number of years we have invested the money. So how much is that? This case, it is 2 years. And R means interest rate. So this case, interest rate is 10%. 10% means it is not 10, It is 10 divided by 100. 10 for every 100, that's 10%. So what is the calculation here? So this interest calculation. So for 80,000, now we have 10, the denominator, so 80 into 2, 1,60,000 divided by 10. So that is, what do you get? 16,000. Simple, right? So this is the interest. So rather than we do the calculation using this column method, what we can do, the calculation using the formula. And of course there is a formula for compound interest as well. So we'll share those kind of things and we'll have more challenging questions when we meet next time. Thank you for watching.